FTX could have been the perfect grift if Sam Bankman-Fried just didn't touch those customer assets. It's fun how absolute power corrupts absolutely, right? You've got FTX, you've got Sam Bankman-Fried, you've got Congress all upset because he got arrested in the Bahamas before he was able to get up on the stage so that they could browbeat him about how bad and how horrible a person he is and how dare he, and no, we do not stand for this. Meanwhile, all they do is collect that money from him. I'm seeing more and more how it's being compared to Lehman Brothers and Enron, two public companies, by the way, and his company's a private play. So this could have been the ultimate venture capital grift. It had all of the components to make this a perfect grift on the venture capital front. So you've got this well-heeled, perfect canvas, checks every single box on the venture capital table. He's young man, very bright, graduated from MIT physics. Parents are super plugged into the Stanford scene, Stanford Law. Aunt is a university dean. He's got all the credentials. Everybody wanted to throw money at crypto. Of course, everybody that had the money could have totally done some due diligence and said no, but it's beautiful. I probably would have fallen for it. What did he do? He took a lot of private equity money, venture capital money. He used it as his piggy bank. And then when things went south, he dipped into customer funds. That is the biggest downfall. And it set back crypto for, a long time. It's going to give it a black eye. Are they related? Only in that the government, who may or may not have been paid off, looked the other way to create this big headache. 100 reasons why they could have done it and should have done it. So you have two different companies that he ran. You had his hedge fund, Alameda Research, and you also had FTX, the crypto exchange. And both of these entities should have been run separate. Unfortunately, the moral hazard was there for both of them to collude, work together, and the moral hazard was too great, and he dipped into customer funds, which was the big no-no and the crux of this whole problem that he gets to deal with now. So the big problem is that the two entities, you had Alameda Research, which is a hedge fund. They had their own assets, their own crypto that they were trading to make a profit. The other company, which is should have been completely separated and segregated from it, is FTX, which actually was a custodian for other people's assets and should only have been able to act as an agent to transact. That did not happen. So in a nutshell, I've been seeing lately a lot of people emailing and talking about the story, discussing Enron or Lehman Brothers and how they're so similar. The new CEO who's been put into this company to manage the bankruptcy, who was in front of Congress yesterday, just taking hits, but it wasn't his fault. It wasn't his fault at all. And all he could do is shake his head and say, yep, this is a bad grift. But to call it Enron or Lehman is a failure because those two companies were public. They actually had already signed paperwork and should have worked in the best interests of the shareholders, and FTX was a private company. So theoretically, if it would have stayed the company itself and going bankrupt, all those institutional investors who signed all those disclaimers saying that, hey, we're big people, and if all this money goes away, we could take it on the chin and we'll deal with it later. Not the individual investors who actually gave their hard-earned assets to FTX to hold and to be the custodian, the fiduciary of that asset, and allow them to trade it. The minute that they touch that money, it's over. So I see people saying regularly this is like Enron or worse than Enron, and that's just not true. Did not affect people in the same way based on the nature of the way the business was set up and created. Let's put it this way. On the private side of the equation, when I say private, I mean private markets versus public markets. On the private side of the equation, most of the people that run in that space, whether you're an independent sponsor like myself or you are an institution with a lot more money behind you, they know the rules of the game, and they theoretically will only put in to a deal what they, with their risk models, can afford to lose, which is not the same as Enron or Lehman Brothers, which were public companies that had public pension money, private pension money, public union money. Individual Americans had access to buy this. Totally different. The people that had access to put money in there are very limited in scope, and it is not going to have the same effect as an Enron or Lehman Brothers. So in a nutshell, you've got a company, FTX, who allowed you to open an account and put your own assets in it, much like a traditional brokerage account, or even simplify it, a bank account, and you take those assets and you are to do with it what you want to do with it, not what the firm wanted to do with it. So we have all of these people playing in the private space. You have independent sponsors, you've got private equity funds, you've got private equity firms, you've got consortiums of accredited investors, private pension funds, people that are set up in a certain way in order to make the most of a deal before it goes public. That's the private space. And then you've got the public space, which is, as we know, the New York Stock Exchange, the NASDAQ, any public exchanges. The venture capital side, the private equity side, the P side of the equation just wants their next 100x, right? And they are willing to take risks, and they have set themselves up with certain risk parameters, hopefully to avoid any real loss. And that's what happened here. It was a perfect grift. End of the day, the private equity forces want their next horse in the race. They want their next Zuckerberg. They want their next Musk. They want their next Sam Bankman-Fried. They want somebody that's going to get them their next 100x. So this brings up another part of the debate that I heard when the market was super hot before the bubble popped. You had people on station talking about private equity being such an amazing opportunity that everybody should have a seat at the table and you should take a test, and if you could pass that test, you should be able to put your money into private equity. Now, that would have been a tragedy. Then the general public would have gotten hurt if they were able to invest in FTX, right? You've got all of these people who maybe are at a lower station in life at this point, younger, maybe they are chasing a dream and they have the opportunity to throw money at a private equity deal that they've never heard of, don't know anything about, don't know how it works. That would have been a shame. So my point in this conversation is to discuss how many people think the private markets are and should be opened up to people that work at a company that have a great idea. These people who originally worked at a company like an Uber, they should be able to benefit and participate in the success of the company, put their hard-earned money into it because they believe in it so much. But that just can't happen. This fraud that just happened through FTX and Alameda just highlights all of the potential downsides, the risk that in this particular private industry business, the risk is already 90% failure, more or less. To allow the general public to invest in private deals like this is nonsensical. And hopefully this will get all of those people in the private world that are looking for LPs and looking for dumb money to invest in their scheme so that they can benefit and profit over it. Hopefully that'll be dashed and some reason will come back into the room. Absolutely no room for it. Fraud pierces all veils. You've got small business owners who lie. You've got any proof of fraud is going to pierce through every corporate structure and get down to your personal assets. It will peel right through every layer of the onion. You think you're protected by a corporation, a charter, individually? No, sir. No, ma'am. You commit fraud, you are going to get it. Thanks for watching. If you like this content, you can find me on Money in the Bank with Frank on all of your favorite podcast platforms, on Facebook, on LinkedIn, on our YouTube channel. Look forward to bringing you more content like this in the future. Thanks.
Thank you for watching this programming on The Merge. What's The Merge? I don't know. It's just something cool and catchy. Like, subscribe. We'll see you next time.